Awesome. Well, thank you so much for having me. I'm sorry I couldn't be there in person. Hopefully, you can all hear me okay and see the slides that I'm showing you. Um, I called this presentation Signal versus Noise because we're in such a crazy kind of current event driven market environment that, there's even though the underlying fundamentals of the economy haven't really changed that much, there's a lot of fear and trepidation that's impacting us in the housing market. Economists are always looking for that holy grail of leading indicators. That's what's going to tell us, what's going to happen in the future. Um, People always love to point at the yield curve, unemployment rate, and all that kind of stuff. For me, this is the holy grail. It's the seven layer dip. You keep an eye on the seven layer dip, and when it drops from seven layers to five, that's when you know we're in an official economic recession. I went to Vaughn's the other day, and we're not all the way there yet, but we've lost the olives, and if you see the guacamole go, then that's when you know we're kind of in trouble. But it does kind of jibe with the broader economic data when you look at the first quarter numbers for GDP, which is our way of measuring the overall strength of the US economy. It went negative for the first time since the recovery began back in about 5 years ago, back in 2020 when we reopened after the pandemic. And that has caught a lot of headlines. It's driven a lot of volatility in the market environment. And of course, that first quarter was kind of punctuated by both the wildfires that happened here in California and also then later in the quarter the kind of beginnings of this trade war which ramped up into April. And again, this caused a lot of newspaper headlines and it caused a lot of volatility in financial markets. One thing to note is that this isn't a big negative number, right? Negative 0.2% is essentially flat for all intents and purposes. But it is noteworthy that we lost some momentum for the first time since the recovery began. And yet, when you kind of scratch the hood of this GDP number, you can see that there's a lot of kind of statistical artifacts, I would say, baked into this number. And what I mean is that because of the trade war, we had a big surge in what I would argue are preemptive kind of pre-tariff imports of both consumer goods, but more importantly, um, business investment in heavy equipment and inventory restocking, basically inventory accumulation. And when you net out that kind of one-time surge in imports, and the kind of technical caveat or note there is that we always take imports out of GDP because we want to get the amount of spending and demand that went to stimulating our own domestic economy, not how much money we shipped abroad. But when you leave those imports in and just look at domestic demand for goods and services, regardless of who we bought those products and services from, that's what the econ nerds call GDD, gross domestic demand. That's just how much businesses and people in the US economy spent. Those numbers were actually still pretty strong. And when you take away government, which we're doing now because we had a big, deep cuts to federal government in the first quarter as well, if you ignore that stuff, you can see the numbers were even stronger, 4.7, 4.8%. So things haven't really downshifted dramatically in terms of the demand for goods and services in the US economy, even as that kind of headline GDP number has folks pretty scared off of financial markets in particular. The problem is, though, and why we can't just kind of spike the football and say we've got nothing to worry about because people are still spending is that a lot of that spending in the orange, the gross domestic demand, was driven by these one-off purchases that were in anticipation of higher tariffs in the future. And those types of spending tend to be one-offs, right? You don't go out and buy a million backhoes throughout the year. You buy one and then you beat that thing to death for the next 10 to 20 years. And so by kind of front loading to get ahead of those tariffs, we enjoyed a lot of that uptick in stimulus and in spending immediately, but that's not likely to persist over the long term. And when you take those kind of one-off business investments out of things, you can see that that more or less offsets the surge in imports that we were netting out on the other side. So basically, either the trade war goes on and investment stays negative and offsets this kind of improvement in the fact that we're not going to import a bunch of stuff, right? So those are essentially a wash, meaning that everything, as always in the US economy, comes down to what are consumers going to do. And you can see that consumers lost some momentum in the first quarter. There hasn't been a noticeable downshift prior to that. But this is where that uncertainty and that kind of current event driven public zeitgeist human psychology piece starts to matter because even though the underlying economy hasn't deteriorated, if I feel scared, then I don't go out and spend. And that leads to real material impacts to the broader economy. And so this one is largely a TBD. The good news is that the Atlanta Fed showing that we should get back to growth in the second quarter. And this one's noteworthy because they were the only shop calling for a negative in the first quarter when all the blue chip forecasts were still expecting growth last quarter. So things should bounce back. Nothing major has changed. And in fact, if you look at the jobs numbers, we're still adding about 150,000 jobs per month. We've added, almost a half a million just over the last 3 months alone, and we're doing that despite the fact that unemployment is in the low 4% range. So we're essentially at full employment for all intents and purposes, and yet we continue to add jobs. So the signal again is holding up relatively well despite all this uncertainty, despite market volatility, et cetera. You can see the same thing if you look at it through the lens of spending, right? That retail sales, even with the stock market all over the map over the last couple of months, we spent more in April than we've ever spent before. And yet, as strong as that signal is, when you ask people how they feel about the economy, we have consumer sentiment now that's basically at 2008 financial crisis levels. It's actually a little bit worse even than it was during the 2008 financial crisis. Outside of June 22, when interest rates started spiking, you have to go back about 45 years to find another point in time when consumer confidence was as depressed as it is right now. And yet, this is juxtaposed against a backdrop or a macro economy, which is at, all-time lows essentially for unemployment, all-time highs for stock market, jobs, GDP, spending, you name it, right? So we've got the signals that all show us still trucking along at a fairly solid clip, and yet people are very susceptible to the noise that exists out there and fears about the future. And although this hasn't metastasized into real hard economic data, I think we can expect that because we're going to be so reliant on consumers, because consumer sentiment is probably in for a bumpy ride over the next 6 months as we figure out what we're going to do with trade and tax policy and all of that kind of stuff, and the fact that credit card and auto debt has grown by about $1.5 trillion since the beginning of the pandemic as well, that we can't expect to keep trucking along at this 3% pace of growth that we've enjoyed up to this point. We just got a new inflation number as well, and this one is material from the standpoint of housing because even as inflation didn't get worse in the midst of this trade war, it didn't improve a ton either. And I think when the Fed meets next week, they're going to be unlikely to deliver more rate cuts. They're still going to want to see more data to understand the impacts of tariffs and whether inflation is going to ramp back up or not. And they're going to err towards the side of status quo rather than rushing into lower rates and try and save the day for the economy, which means that the outlook for interest rates is that we shouldn't expect a ton of improvement between now and the end of this year, or even really through the end of next year. When you look at where the Fed funds rate's going to be, where the bond market's going to be, and where mortgage rate spreads are going to be, and you need to look at all three because, again, us as regular human beings don't get to borrow at the Fed funds rate as much as consumers like to obsess on what the Fed is doing. We don't borrow at the Fed funds rate. We need to look at treasury market spreads. We need to look at mortgage rate spreads. And when you add those two things on, even to an optimistic outlook for what the Fed's going to do, it's hard to see rates dropping much below 6.5% over the near term. And indeed, if you pull the data over the last couple of weeks, we've been in the high 6, even 7% range. And I joke this one kind of looks like my weight loss journey, right? A lot of ups and downs, but really over the last 3 years, no real material progress to report, right? We're still higher now than we were even before the Fed cut rates the first time. So we've had three rate cuts and mortgage rates have not improved. This is why you don't obsess on the Fed and also why you don't wait around for rates because prices continue to leave you in the dust as well. The other place I think that we're going to see some volatility, which is probably going to have a bigger impact in our coastal employment centers, more so than it will in the Central Valley. Nonetheless, though, this has a big impact on broader macroeconomic conditions, and that's the fact that the stock market is overvalued. So this chart shows you the value of the stock market relative to the earnings of the companies in the S&P 500. This is how you would evaluate any individual asset, right? If I was going to go out and buy a house, pay 400 grand for it, I can rent it for 2 grand a month, right? That's $24,000 in income a year. I can work out a cap rate, like how long is it going to take me to get my 400 grand back, right? And it's going to be a little less than 20 years in that kind of a scenario, right, which would give you a kind of 20x number. Well, if you do that calculation for the entire US stock market as proxied by the S&P 500, you can see that on average the stock market's worth about 15 times earnings, and that's been true going all the way back through the full history of modern financial markets. This chart goes back to 1871. And if you look at where we're at the beginning of June, we were at a 36, 37 times earnings. And that is, you don't have to be a mathematician to realize that that's more than double 15, right? 36 is more than twice 15, meaning that these valuations that exist, especially for these chip driven, kind of GPU companies, the Mag 7, are not being backed up by earnings right now, meaning that we should expect probably more stock market volatility. The only time we've ever seen valuations as high as they are now relative to earnings was at the end of the dot-com bubble, right before things corrected, and in September 1929, right before Black Friday and the Great Depression. So I can't say that this is a prediction. If I could predict the stock market, I wouldn't even have to be here doing speeches all over the state. I would just be, counting the stacks on a beach somewhere. But this suggests that there is, asset market um, risk in the US economy. To get back towards even the top end of the normal range, the stock market would be cut in half. To go back to the average of 15 times earnings, it would mean a 60% correction on the US stock market. And that would have, significant implications, not just for that market psychology, right? But also on real honest to goodness home sales in California, the top end of the market. Even in Tulare County, although we've had more middle market kind of retail owner occupant action there than we have in other parts of the state. But even in Tulare, when the stock market does well, high-end home sales do really well, and when the stock market goes down, million and up dries up pretty quickly there. So this is both a kind of consumer confidence issue with the stock market, but also a housing sales, new transaction move up, kind of a real bread and butter issue for us. And what you can see if you kind of translate all of this macro stuff back down to what's happening for us in the housing market this year, you can see that after we were recovering at a pretty solid clip towards the end of 24, year over year growth in closed transactions was averaging about 20% through the last quarter of last year. As we got into the first quarter of this year, both because of the fires and then subsequently because of the trade war, you can see that we really lost all momentum and have really plateaued on our way to 300,000 closed sales for the year. In fact, we were about 85% of the way to my forecast for 2025 by February, and we've essentially made no further progress in the market since then. Luckily, we're overperforming locally, but you can see that as time has moved on, we've gone from everything basically over 500K growing by double digits at the end of last year to by January of this year, it was really only stuff priced a million and up that was growing. And by May of this year, only 10 million and up, or excuse me, 5 million and up was growing. And even there, the pace of growth has been dramatically scaled back. And so you can see why this kind of signal versus noise story matters. Employment and every other macro indicator is still at all-time high levels, but consumer confidence is super down in the tank, and you have people both thinking that the market's about to crash and that rates are going to come down a ton. And even with a relatively strong macro environment, you're seeing these home sales really start to decelerate pretty substantially. Again, we're outperforming in the local market. You can see we're actually up 9% this year compared to just a couple of percent for the state as a whole. A lot of that is because of growth at the high end of the market. You can see that, yes, 4 to 500's up about 20%, even 3 to 400's up about 11% this year. But if you look at over a million, I think there's been 20 homes closed or 19 homes closed countywide over $1 million this year, compared to, I think, seven through the first 4 months of last year. So we're more than double at the high end of the market, even with all of this volatility. But that means we're also exposed, because if the stock market corrects itself, then we lose, one of our fastest growing segments of the market. Other thing I want to point out is that even with a bit of a modest recovery posted for this year so far, we've still got a long way to go to get back towards normal levels of transactions in that 4,000 unit range that we were enjoying even before rates hit 3%. When you look across the county geographically, you can see that it's more or less across the board where the growth is happening. It's not just one standout area. We've got growth in the core, we've got growth in the outlying areas as well. But we didn't enjoy that same ramp up when rates, kind of in or dropped to 3%. We didn't have those same kind of boom years, meaning that we didn't have as big of a downturn. But you could see that part of this is psychological, right? This slowing in sales currently. This light blue bar stuff here that I'm showing you is a new indicator that I'm working on at C.A.R. It measures percentage of withdrawn, or it measures withdrawn offers as a percentage of offers submitted. And you could see that as the fires happen and then the ramping up of the trade war, and market volatility, that the cold foot index, as I'm calling it, has tripled from 1 to 3% of all submitted offers out there. And so, whether again backed up by the hard signals or whether driven purely by noise, the fact of the matter is that buyer demand has taken a step back this year. Meanwhile, supply has continued to normalize from these extremely depressed kind of pandemic levels. In fact, last week, we were at, a 5-year high for closed transaction, or excuse me, active listings. But if you look at this chart here, you can see that they're not ever increasing. In fact, they've started to plateau. I would argue we're probably past peak for listings for the year, meaning that we're stuck at around 3 months of supply. But what do you get when you have less demand, more supply? You get this normalization of home prices, which are no longer growing by double digits and are now closer to the low single digit range. Here's another fun thing that we're doing with the forms data. We're looking at supply and demand gaps as a leading indicator for home prices. So what I'm showing you in the blue, dark blue, is the number of buyer rep agreements signed compared to the number of listing agreements signed. So how many buyers do we have coming into the market? How much inventory do we have to fulfill that new home buyer demand? And you can see that as we got into this year, both because of more listings and also fewer buyers coming into the market, that shortage of active listings really shrunk back to almost being on par. We had about as much inventory coming on as we had new buyers coming into the market for the first time in a while. But if you look at the May number, buyers have started to come back a little bit quicker than the new listing agreements, and so that shortage is starting to reemerge. So the point here is that we don't expect prices to fall a ton, because we're still in a very tight housing market. It's just a little bit more normalized with more listings, less demand than we've had up to this point in the cycle. But don't kind of fool yourself into thinking it's a buyer's market now. We're still at 3.5 months of supply. We're just no longer back at 1.5 months when things were this kind of white hot, super competitive market environment. You can see the same story if you look at it through days on market. homes are still on average going pending in 3 weeks. They're just not going pending in 1 week, right? So this is important for buyers and sellers both to understand. Yes, the pendulum has swung away from sellers a little bit. You have more options as a buyer. You have more wiggle room to negotiate as a buyer than you've had in many years, but that doesn't mean you come in and name your price and get all these free concessions. Similarly, on the sell side, just managing the expectations because we're not back here when stuff was going pending in just over a week's time frame, right? Here's the countywide median prices, which are essentially still at all-time high levels across the county. This is one of our more affordable parts of the state, and yet we have a median price that's in excess of most other parts of the country. And so affordability, even in California's most affordable markets, is still pretty challenging. And if you look at the trend, right, home prices in Tulare have not gotten any cheaper. In fact, even when rates more than doubled from 22 to 23, home prices didn't decline at all. They stopped and took a breather, and then they rose again in 24 and are on track to rise again in 25. In fact, I'd be asking those kind of long-term gainfully employed renters in Tulare County, like when has waiting on the sidelines behooved you, right? Because if you go back to the 1990s, prices have really only gone one way. The orange is the actual honest to goodness Tulare County closed median home price. A lot of this is just driven by incomes, right? Income on the right hand side, this blue line has also risen substantially, particularly in the aftermath of the pandemic. But, and so, prices may be a little bit inflated because of all this drop in rates and pass through of purchasing power and kind of chronic undersupply of inventory. But even if you just take the straight up median household income in Tulare and multiply it by four, you get a home price line that looks like the gray stuff, which is still more or less right where the actual median home price is in Tulare. So, point is, stop waiting for rates because we have a housing supply shortage, which is where you get charts that look like this and prices that just continue to become less and less affordable the longer you wait to get into the housing market. What about this idea of waiting for prices to crash? Prices are a little bit decoupled from incomes right now. Every quarter, we go through and calculate an affordable home price. We can do that by just taking existing incomes that we know how much people make, current interest rates, and the fact that we want people to spend about 30 to 35% of their gross pay on housing and reverse engineer what is the home price that kind of meets those criteria. If you do that calculation for the state as a whole, the median wide, or excuse me, the statewide median home price should be somewhere in the 475 to $550,000 range, when in fact it's actually over $900,000 currently. So home prices have become inflated in California. One of the good things, or saving grace perhaps, is the fact that home prices in California are never at that affordable price because we're such a nice place to live, because we have such a strong economy. California is almost always about 20% above that kind of market clearing affordable price. But even taking that into account, prices now are about as inflated compared to income as they were back during the housing bubble of 2004, 5, and 6, which means that in the worst case scenario, if that were to materialize, prices would need to drop about 30% to get back to that kind of historic average premium of about 20% above that affordable home price in the state. And unfortunately, that number is pretty universal no matter where you look in California. The reason why I think we are still not forecasting big home price declines is because we're not going to get the kind of distressed inventory that would drive those kinds of price declines. Why are we not going to see the foreclosures in the severe numbers that we saw last time around? And strike one is the fact that again, most people are paying their mortgages on time, and so you don't throw the keys back to the bank on a property that you're not even behind on payments on. One of the reasons why I think folks are so inclined to prioritize those mortgage payments and keep those things current, even if we were to see the economy deteriorate, is because we have so many of these homeowners out here in sub 4% mortgages. In fact, two-thirds of Californians that have a mortgage have that mortgage at or below 4%, meaning that you're facing a pretty stiff penalty for moving. And so even if you lose your job and fall on tough economic times or are worried about market volatility, et cetera, your prospects for leaving that house and going somewhere else, and take it from somebody who sold a big property at 3%, moved into a tiny property at 7, moving somewhere else is much more expensive. And why you're going to let a lot of other stuff go. You're going to tighten your belt in a lot of other ways to keep this mortgage going, versus kind of foreclosing again, because your alternatives are going to probably cost you a lot more, even if it means renting or doing something like that. So that's kind of strike two for the foreclosure forecast. And then the other thing, and I think probably strike three, is the fact that 90% of California homeowners, again, those with a mortgage, have an LTV that's about 70 or lower, meaning that they've got at least 30% home equity. And that's a relevant number because when we think through those overinflated home prices in California and how much they would have to fall to get back to a normal, affordable level, that was about 30%, right? And that would still leave most people in California no longer, or still not underwater on their home. So they're on time on the payment. They've got the lowest mortgage rate of all time, and they can absorb a little bit of price declines without having to throw the keys back to the bank. And so that doesn't mean everybody would escape a worst case scenario unscathed, but I think this prevents us from getting up to the 10, 12, 15 months of supply that we got to during the last foreclosure crisis, which is really what got the ball rolling downhill so much when it came to price declines, right? The other thing I think that's our kind of backstop on this is that because we have so many long-term homeowners in California, we've got about a third of homeowners who aren't even covered by those mortgage stats that we just went over because they own their homes outright completely. And there's really no foreclosure risk for this kind of big, not insubstantial segment and slice of the market. So when we put all this stuff together, how do we translate this through to the buyers and sellers out there, and kind of cut through the noise and get back to some of the signal? Bottom line on interest rates, I think, is stop waiting for rates. Once you add on the bond market and mortgage rate spreads and the fact that the Fed's probably not going to be able to cut as much as we want them to be able to, it means that we're looking at 6.5% interest rates for the foreseeable future. It does not behoove you to wait around for interest rates, especially when interest rates today are essentially bang on the 30, 40-year historic average of what interest rates normally look like. People forget that when they're rooting for interest rates to go back to 3%, they're maybe, unwittingly, but nonetheless rooting for themselves to also lose their own job, right? Because the only time you see rates that drop materially below 6% for any noticeable amount of time is when terrible things have happened economically. So stop waiting for rates. Rates today are normal. The thing that we had a few years ago, that was the anomaly. Today is the norm, and you can always take advantage if I'm wrong and go out and take advantage of that lower rate in the future. But the longer you wait to get on the property ladder, the more time you spend down here on this yellow line instead of making this leap into wealth creation and all of the stuff that is what home ownership is all about in the first place. It's not about timing the market and buying low and selling high. You got to live somewhere anyway. You might as well pay your own mortgage rather than your landlord's and start accumulating the equity, which is almost guaranteed by virtue of the fact that we've got such a chronically undersupplied housing market. And lo and behold, when you look at the actual stats on who has money in this country, it's no surprise that renters never get any better off, and in fact weren't any better off in the most recent data than they were 30 or 40 years ago, and that homeowners are the only ones with any wealth in this country. Also, good to know for buyers is that the main limiting factor that you've been facing up to this point, which hasn't been interest rates, it's been a lack of inventory for you to go out and buy, is moving in the right direction. You've got a 5-year high for inventory. You want to buy now before all the other buyers get into the market. You want to go to Disneyland when the lines are short, right? That's the analogy there. But also, don't get it twisted and think that people are just going to be giving you all kinds of big concessions and you can come write a super under list price offer and get a free roof and the solar paid off and a rate buy down and all of that stuff. There's more options, but it is not a buyer's market still in California because we're still at 3.5 months of supply. It's a better time to buy for you, but you still got to be strategic. The reason why you want to buy sooner than later, though, is because we still don't build any housing in this state. We're easily about 2 million units short when it comes to just keeping up with all the population growth that we've experienced since the 1970s, meaning that home prices really can only ever go one way. We need to build a couple million units just to get out of the hole. Forget about, getting affordability under control. This is just to stop the bleeding, meaning that, which, is probably unlikely to happen, meaning that your home and whatever real estate you can own will probably continue to appreciate, and why over the long term prices in California have only ever gone one way, and that's up. And you can kind of see that play itself out locally, right? That even with all of the ups and downs, if you look at transactions in Tulare County by price point, you don't have to be an economist to look at this chart and understand it, right? That the more time has gone on, the less of the housing stock in the local economy is below 300K or even below 400K. You go back 10 years, right? And you're talking about 95% of all the homes that closed in Tulare County were below $400,000. You fast forward to today when the median price is $385,000, right? You're talking about almost one out of two properties are closing above 400K, right? You have about one out of five that's closing over $500,000. And again, this is supposed to be one of our most affordable parts of the state. And so even with all of that great income growth, housing, because of the shortage, becomes less and less affordable, less and less accessible to you as a renter, would-be home buyer, the longer you wait. You can always take advantage of the lower rate if they do end up going down more than forecast in the future, but you can never go back and pay that $89,000 median price that we had back in the late 1990s, right? And so you get in when you can, take advantage of low rates if and when they do end up materializing. But homes are still selling quick, right? And that's why you can't just name your price. And this is also a function of just that lack of supply and the ongoing appreciation. So, you want to get into the market as soon as you can, and you want to do it before things get much more competitive again, because all the other buyers are waiting for good stuff to happen too. What about on the sell side there? I think the recipe for success is managing expectations. It's a phenomenal time to sell a house in California still, but you just have to be a lot more strategic than you could get away with being a few years ago when rates were at 3%, right? You've got more listings out there competing for those buyers, right? And as sellers, we haven't had to think about ourselves as competing against other listings. Now you have to compete a little bit more. There's still buyers who will be willing to buy at 7%, but they're more picky than they used to be because their payments are a lot higher. And they also have other alternatives, which is not the case a few years ago. So great time to sell, but you got to price it right. You got to be more strategic. You probably got to do more on the pre-listing side than you could get away with doing a few years ago, right? It's still a great time to sell at 22 days, right? When my dad was a realtor in the 80s, he would have to sit open houses for like 6 months to get something into escrow, right? So still a great time to sell, but it's just taking about twice or three times longer than it did 2 years ago. This is information you want to make sure your sellers understand on the front end so that they're not sending you a bunch of angry voicemails 3, 4 weeks into the listing going, you suck as a realtor. You don't know how to market my property and all of that, when really it's just a function of the market having changed. You want to make sure that they understand where the market is today, and aren't kind of basing their own expectations on something that happened to their buddy or their neighbor or their relative a few years ago, right? And again, other sellers are reducing. There's more competition for those buyers, and so it just behooves you to be strategic. And for you guys, I think what that ultimately means is just to expect more bumps in the road. Interest rates are probably going to disappoint. I know we've been longing to feel like we could go back to normal after all the crazy stuff of the last 5 years with the lawsuits and the buyer rep agreements and the pandemic and interest rates being all over the map and all that stuff. But I think we've just got to still expect more bumps in the road. Seat backs, upright, tray tables, right? All that kind of stuff. The good news is the long-term housing prospects are still very much alive and well, and housing is a long-term game. So I think we can do ourselves a favor and make a material impact on our own business by getting people focused more on the long run, less on the short run in particular. I think we also have to manage expectations on the buy side and on the sell side. It's a great time to buy. The market's not about to fall apart. If you wait, you're not going to save a bunch of money, and you actually have more opportunities than you had as a buyer in a long time. On the sell side, the same stuff in reverse, right? Buyers have more opportunity. There's more options out there. So we've got to be a lot more strategic and have realistic expectations. And that's where we need to really make sure that we're doing our job on both sides of the equation, managing those expectations, bringing everything in our arsenal and our bag of tricks because consumers need every advantage in this kind of market with insurance and inventory and prices and affordability and rates and uncertainty and everything else kind of going on in the background, which is great for your job security, but it also means just that you're going to have to keep your foot on the gas and really bring it this year to make sure that it's a successful market because we don't have the market itself going up enough to where you can just throw it in cruise control. And so I think a lot of the game this year will be a communications game. We do have the market improving. That's about a 5% increase, although I reserve the right to downgrade this if the uncertainty persists. But regardless, even with a couple of good years of growth, you can see that normal is still several years out. So moving in the right direction, yes. Take your foot off the gas? Absolutely not. I think that if you embrace that role as trusted advisor and really lean into helping consumers and being that market expert, I do think sky is the limit. Tulare County is outperforming the rest of the state. We're not as exposed to those broader stock market fluctuations as places like LA and San Francisco. But nonetheless, I think that you're going to want to make sure that you keep your foot on the gas so that you're carving off as big of a slice of this growth for yourself as humanly possible. And again, I think if you embrace that, then sky's the limit for 2025 and beyond. And I'm so sorry about all of my internet shenanigans, but I do appreciate you always inviting me back and the opportunity to share our update with you today.